For decades, one phrase has really dominated global manufacturing: made in China.
Hmm. Absolutely everywhere.
It's on everything, right? It's a testament to this economic miracle, a symbol of industrial scale that we really haven't seen before. It shaped everything from our phones to car parts.
Pretty much anything you can think of.
Exactly. But what if that reality, which seemed so permanent, is actually shifting? What if the whole structure of global supply chains is being rewoven, not
Huh.
just for diversification, but maybe for resilience too?
It's a huge reevaluation, isn't it? Where and how the world makes its stuff.
It really is. So today we're taking a deep dive into a really fascinating stack of sources that help us unpack what's known as the China Plus One strategy.
Right.
It's a concept that's fundamentally changing how companies think about their global footprint, and honestly, it has massive implications for the entire world economy.
That's right. Our mission today really is to explore what China Plus One actually means in practice. We want to figure out why it's gaining so much traction right now.
Yeah, more than just a buzzword.
Exactly. Moving beyond the buzzword to understand the deep economic, geopolitical forces driving this shift. Then we'll look specifically at India,
Okay.
how India is actively positioning itself as a key alternative, looking at the big steps it's taken to attract global industry.
Makes sense.
And finally, we'll weigh the unique challenges, but also the opportunities that both China and India face in this really dynamic, evolving landscape.
So it's not just a simple swap.
Oh, definitely not. It's complex. Understanding the nuances is absolutely key if you want to grasp where things might be heading.
Absolutely. So think of this as your shortcut, really, to being genuinely well-informed on one of the most critical economic trends happening right now.
Mm-hmm.
We're going to pull apart different perspectives, different insights from our sources to give you a really comprehensive, nuanced understanding, something that goes way beyond the headlines.
Sounds good. Let's get into it.
Okay, let's unpack this. To really get why China Plus One is such a big deal, we first need to understand the sheer scale of China's dominance, the world's factory thing.
It's hard to overstate it, really.
It really is. For decades. Since those economic reforms back in 1978, China just went on this incredible transformation journey, became one of the world's fastest growing major economies.
An astonishing pace.
Right, and multinational corporations, they just flocked there. They were drawn by this irresistible package.
Yeah, what was in that package?
Abundant, cheap labor, first off. Readily available natural resources, incredibly low taxes, and at least initially, a regulatory environment that was, let's say, less strict.
Much less stringent, yeah.
Yeah.
Compared to Western nations, especially on things like environmental rules or worker protections.
Exactly. And our sources really highlight how that Made in China tag didn't just become common, it became the global standard.
You couldn't avoid it.
No way. You pick up almost anything around you, chances are it was made there. And it wasn't just the finished products, was it?
No, that's a key point. Even raw materials or crucial components for things assembled elsewhere often started in China.
There's this really telling statistic, I think, from 2019, Statista and UNSD.
Yeah, I know the one.
It said China's total production output was almost equal to the combined capacity of the next three largest manufacturing countries globally.
The next three. Combined.
Combined. That's not just dominance, it's an incredible level of concentration, right? Created this deep global dependence.
It did. And for decades, companies chased those lean, just-in-time supply chains. China's efficiency basically set the benchmark.
So going anywhere else seemed too expensive, too risky.
Pretty much. But the hidden cost of all that concentration was this profound vulnerability it created.
A vulnerability that, well, we definitely saw exposed later on.
Absolutely. What's truly fascinating here is digging into the factors that actually enabled that rapid growth beyond just the huge population.
Right, it wasn't just numbers.
No. First, the obvious one, low labor cost.
Yeah.
China had this incredible supply of low-paid workers easily available, huge draw for companies wanting to cut production costs.
That demographic dividend they talk about?
Precisely. Factories could scale up super fast without wages getting out of control, at least initially.
Okay, so cheap labor was number one. What else?
Well, it wasn't just cheap hands. China also built up this remarkably robust manufacturing ecosystem.
Ecosystem meaning?
Meaning the strong, interconnected value chain. Suppliers, distributors, manufacturers, all working together, often geographically close.
Ah, okay, like you need a specific part.
Exactly. You need a specific sensor, a custom plastic mold, a certain circuit board. In China, you could often find a specialized supplier, literally miles away, sometimes in the same industrial park.
Wow.
with decades of experience,
Right.
able to deliver at huge scale, good quality, incredibly fast. So it wasn't just cheap labor, it was this entire fine-tuned system.
Mm.
Logistics, skilled workers, supporting industries. It made mass production incredibly efficient.
And that efficiency just drove costs down even further.
Right. Created this powerful, self-reinforcing cycle of growth.
Got it. And the third element?
The initially permissive regulatory environment. Compared to, say, Europe or the U.S., China's rules on health, safety, employment, environment, they were just less stringent back then.
So less red tape, lower compliance costs?
Significantly lower. Made it faster to set up, less overhead.
Yeah.
Now, sure, Western companies had concerns initially,
Right.
but China gradually addressed many of those over the years, making it seem more reliable, more attractive. This reduced friction, plus the scale and cost advantages. It let China expand its industrial base at just a breathtaking pace.
Something like 35 years to do what took the West much longer?
Exactly. They offered what the global market needed, amazing efficiency and cost effectiveness at scale, and they delivered.
Okay, so that sets the stage. China as this unshakable manufacturing giant, but now things are changing. And here's where it gets really interesting. Why now? Why the push for +1?
What's driving the shift away, or at least the diversification?
Exactly. Our sources point to several big pressures making companies rethink their reliance on China.
Okay.
The first major one seems to be this realization of over-concentration risk.
Putting all your eggs in one basket.
Precisely. Companies, even whole economies like the EU and the US, started seeing the potential downside, how dependent they'd become.
The crippling effect if something went wrong just in China.
Right. It wasn't just theory anymore. Things like natural disasters, specific labor issues, or geopolitical tensions started showing the cracks.
Hints of that vulnerability.
Yeah. Boardrooms suddenly woke up to how a single problem in one country could halt entire global industries.
A real wake-up call.
Definitely. Now, the term China +1, it was actually coined maybe a decade before.
That's been around a while.
That the U.S.-China trade tensions in 2019, that really kicked things into high gear, didn't it?
Oh, absolutely. That significantly fueled the urgency. The tariffs.
Huge tariffs on tons of Chinese goods. It wasn't just a small cost increase, was it?
No, for companies running on tight margins, it fundamentally changed the math. The profitability of sourcing only from China.
Made it much riskier, much more expensive overnight for many.
Forced a serious, immediate look for alternatives.
Okay, so trade tensions were a major catalyst. Then came
the pandemic.
The COVID-19 pandemic and China's zero-COVID policy, arguably a massive turning point.
Huge. The industrial lockdowns. Sustained, unpredictable, across major manufacturing hubs.
Led to those massive global supply chain disruptions we all felt.
Remember the empty shelves? The delays?
Oh, yeah. And the sources say the unpredictability was the real killer.
Exactly. You can manage a known delay, maybe, but these sudden, indefinite halts under zero COVID, they made those lean, just-in-time supply chains basically unworkable for many.
Raised serious doubts about the reliability of Chinese supply chains.
Credibility took a big hit in the eyes of global corporations. It was a stark, tangible demonstration of the risks.
Okay, so risk, trade wars, pandemic.
Yeah.
What else is pushing companies?
Well, on top of all that, China itself is diminishing its low-cost advantage.
It's getting more expensive to produce there.
Definitely. The era of ultra-cheap production is fading. Our sources show producer price inflation hit a 13-year high recently. Costs are just rising across the board.
And labor costs, too.
Big time. Wages have been climbing sharply. Average annual wage growth was around 10% between 2012 and 2019.
Wow, 10% a year.
Yeah. And with labor shortages emerging, that's expected to keep going up. Perspective check. China's average hourly manufacturing wage is now around $5.50 USD.
Okay. How does that compare?
It's actually higher than Mexico's now, which is about $4.50.
Really? So the whole China's cheap narrative is outdated?
It's a narrative from maybe a decade ago. We're seeing economic maturity reflected in rising labor costs. For low-margin goods, that fundamentally changes the calculation.
Pushes companies to look elsewhere. And other costs?
Increased transportation costs, rising energy costs, they all add to the pressure.
Makes sense. And regulations. You mentioned they were looser initially.
Right, but now China has implemented a much stricter regulatory environment.
Okay, so catching up in some ways.
In many ways. They become much more serious about enforcing rules on health, safety, employment, the environment. That increases compliance costs, operational complexity.
And for tech companies.
Yeah.
Anything specific.
Yeah, a big one is data privacy, like the Personal Information Protection Law, PIPL, from November 2021.
What does that do?
It requires companies to get explicit permission to share personal user info outside China. That adds compliance costs, creates uncertainty for global operations, data analytics,
And there are penalties for not complying.
hefty ones. Adds another layer of risk and expense.
Okay. And one last factor often mentioned.
Intellectual property theft risk.
Still a concern.
It continues to be a persistent worry for international companies, according to various reports, even with China making efforts to improve IP protection.
So you put all that together, the risk, the trade wars, the pandemic disruption, rising costs, stricter regulations, IP concerns.
It paints a pretty clear picture, doesn't it? Why companies are actively seeking alternatives and embracing this China plus one idea.
Right. So let's define that strategy more clearly.
Okay, if we connect this to the bigger picture, China plus one is essentially a global business approach. Companies strategically diversify their manufacturing, their supply chains.
By adding other countries alongside China.
Exactly. That alongside is crucial. It's not usually about abandoning China entirely.
More like other markets, too.
Precisely. Don't put all your eggs in one basket.
Mm.
It's especially common for companies with complex supply chains, high-tech stuff, big consumer brands. They really feel that vulnerability of single-country concentration.
And the main goal is?
To divide risks, make the business far less vulnerable to future disruptions, whether it's geopolitics, trade wars, or another pandemic.
Building resilience, basically, redundancy.
Exactly. A proactive move towards more robust global operations.
Okay, and what are the big advantages for companies that actually do this?
Well, the core advantages are pretty clear. First, and maybe the most important, diversification of risk.
Spreading the bets.
Right. Spreading production across multiple countries makes you way less vulnerable to localized problems.
Like a factory shut down somewhere.
Yeah, or currency swings in one market, or
Right.
tariffs hitting just one country. If you have parallel production, say, in China and Vietnam.
A problem in one place doesn't stop everything.
Exactly. You can absorb the shock much better. It's moving from that fragile, just-in-time model.
To more of a just-in-case approach.
Precisely. Building a more shock-resistant supply chain.
Okay, risk diversification is number one. What else?
Number two is definitely potential cost savings.
Because other countries are cheaper now.
Often, yes. While China's labor costs have shot up, workers in many other Asian countries, Vietnam, India, Bangladesh, are generally less expensive for certain types of manufacturing.
Especially labor-intensive goods.
Exactly. So companies can maintain or even improve cost efficiency in specific parts of their production. That's a strong economic incentive.
Makes sense. And you mentioned a third advantage. Less obvious, maybe.
Yeah, market access. This one's powerful. By setting up manufacturing in emerging Asian economies.
Get your foot in the door of their local markets.
Right. Early, direct access to these rapidly growing consumer bases. Gives you a head start. Time to build your brand, set up distribution, adapt products locally.
Before everyone else piles in.
Exactly. Our sources mentioned Intel doing this way back in 2010, opening a billion-dollar chip plant in Vietnam when China was already getting pricey.
Wow, that was early foresight.
It was. And lots of Japanese firms in China also diversified into ASEAN countries around then. They saw the long-term benefits, not just for production, but for tapping into these huge future consumer markets.
Okay, so risk, cost, market access. But choosing which plus one country, that can't be easy.
Definitely not. It's a complex calculation. Not one size fits all. Depends heavily on the industry, the product, how much risk the company can stomach.
What are the key things they look at?
Well, labor costs is still big, obviously, but also infrastructure ports, roads, power grids, how good are they? Overall, country risk, political stability, bureaucracy,
Red tape again.
always a factor. And of course, the size of the local market itself, plus many other things.
Let's dig into those country risks. You said every place has pros and cons.
Absolutely. Every potential plus one has its challenges.
Yeah.
Take Vietnam and India, huge potential, right? But they face operational risks. Things like corruption, maybe a lack of accountability sometimes, bureaucratic hurdles that can make business more complex than, say, in China was, or is in some ways.
Okay.
What about others?
Thailand, you have risks of social instability sometimes. Indonesia, huge market. But you worry about natural disasters, earthquakes, tsunamis, plus big infrastructure challenges because it's so spread out, all those islands.
So there's always a trade-off, a bright and a dark side, as one source put it.
Exactly. No perfect solution. Investors have to weigh these very carefully against their own needs and risk tolerance.
You also mentioned something else influencing the choice, FTAs.
Right. Free trade agreements. Hugely important.
Why are they such a big deal?
They can significantly boost a location's attractiveness. think about ASEAN countries. They have strong FTAs with major markets like Japan, South Korea, Australia, even China itself.
Okay, so that
It
means
means companies operating in those ASEAN nations can often trade with these huge markets with minimal tariffs, sometimes zero tariffs if they meet the rules of origin. Ah, so it makes exporting from there much cheaper.
way cheaper. Imagine a 15% tariff versus a 0% tariff on your components or finished goods. That goes straight to the bottom line, affects competitiveness, market access.
So FTAs can really put certain countries, like in ASEAN, ahead in the race.
Definitely. They integrate them more smoothly into global value chains, making them highly attractive plus-one options.
Okay, so pulling this together, what does it really mean for global manufacturing? Is it China out, everyone else in? Or is it more
It's
nuanced?
definitely more nuanced. That difference between +1 and a full -1 is key.
Right.
Our sources are clear. Companies are opening new assembly lines in other countries, yes. But
There's a but.
there's a but. They often remain, especially in the short term, heavily dependent on China for crucial parts, specialized materials, complex components needed for production.
So China's still deeply embedded in the supply chain, even for stuff assembled elsewhere.
Absolutely. It shows just how integrated China became. Think specialized chips, rare earths, complex subassemblies for electronics or machinery.
Stuff that's hard to source elsewhere at the same scale or cost.
Exactly. China perfected producing those at immense scale and cost, finding alternatives that match that efficiency capacity or even just the variety. It's not easy. You can't just untangle decades of integration overnight.
Okay. So that dependency is one reason not to leave entirely. What else keeps companies there?
Well, the reality is cutting off China completely often just doesn't make business sense for many multinationals.
Yeah.
Two big related reasons. The incredible supply chain efficiencies built up over decades there.
That whole ecosystem you talked about?
Right. The dense network of suppliers, skilled labor, sophisticated logistics, it's hard to replicate quickly.
And the second reason?
The sheer size of the Chinese domestic market, it's enormous. A massive consumer base that global brands simply can't afford to ignore.
So leaving means sacrificing efficiency and market access.
A tough pill to swallow.
Mm.
Which is why China Plus One is usually an addition, not a full replacement.
Diversify, reduce risk, build resilience, but don't necessarily disengage entirely.
Precisely. Global value chains are constantly adapting, restructuring. This shift is part of that evolution. But a complete exodus from China, that's not the main trend right now for most big players. They want resilience, not rupture. China's role is changing, but it's still central.
Okay, let's unpack this for India specifically then. Seeing this global shift, India hasn't just sat back, has it?
Not at all. India's been incredibly proactive, making comprehensive steps to position itself as a really viable, attractive alternative to China, actively trying to pull a share of that global industrial hub its way.
And it's not just one thing, right? It's a multi-pronged approach.
Absolutely. Policy reforms, infrastructure building, big financial incentives, the whole package.
Okay, let's break those down. What's the first big thing India's done?
First, and probably the one getting the most headlines, are the production-linked incentive schemes, the PLI schemes.
Ah, yes, the PLIs. Heard a lot about those. What sectors are they targeting?
Key growth areas: electronics like mobile phones and semiconductors, pharmaceuticals, especially APIs, the raw ingredients, and medical devices, textiles, automotive, solar panels.
So, strategic sectors. And how do the incentives work?
They offer direct financial rewards based on incremental production and exports. So the more you make and sell abroad, above a baseline, the bigger the incentive.
So the government is essentially co-investing, betting on growth.
Well, pretty much. Tying cash incentives directly to increased output and exports. The goal is clear. Boost domestic manufacturing, lure global firms, make it financially compelling to produce more in India.
Okay, PLI is a big one. What else builds on that?
Well, the Make in India initiative, which actually launched back in 2014, is still a cornerstone.
Right, that's been around a while. What's its focus?
Encouraging manufacturing in India, both local and foreign, mainly by simplifying business rules, actively promoting foreign direct investment, FDI, and crucially, improving infrastructure and worker skills across the country.
Creating that enabling environment.
Yeah.
And they've actually made progress on simplifying rules, the ease of doing business stuff.
Yes, significant ease of doing business reforms. They've digitized and streamlined a lot of business approvals, compliance processes, trying to make it faster, easier to navigate the bureaucracy.
Cutting red tape.
Trying to. They've repealed or simplified over 1,500 old, archaic laws, introduced the Insolvency and Bankruptcy Code, the IBC.
Why is the IBC important?
It aims for much faster resolution of business disputes and bankruptcies, gives investors more certainty, a clearer process if things go wrong, a critical safety net.
Okay. And reforms at the state level, too.
Yeah, land and labor reforms are happening at the state level. Places like Uttar Pradesh, Gujarat are trying to make their local environments more investor-friendly, simplifying land acquisition, offering more labor flexibility.
Got it. So, PLI, Make in India, ease of doing business.
Mm.
What about attracting foreign money directly?
That's where FDI liberalization comes in. Big focus here.
How have they liberalized?
Now, 100% FDI is allowed under the automatic route in many key sectors: defense, telecom, manufacturing.
Automatic route,
Yeah.
meaning no government pre-approval needed.
Exactly. Foreign investors in these sectors don't need prior government sign-off. They just notify the Reserve Bank of India after the investment.
That must speed things up considerably.
Hugely.
Mm.
Shifts it from seeking permission, which can be slow and uncertain, to just notifying.
Right.
Much faster entry, more certainty for global companies.
Okay, now, infrastructure. That's always been a big point about India.
And they're tackling it head-on with massive infrastructure development.
Like what specifically?
Building new industrial corridors. You hear about the Delhi-Mumbai Industrial Corridor, DMIC, the Chennai-Bengaluru one, designed specifically for manufacturing and logistics, aiming for world-class facilities.
And general logistics, ports, roads, rail.
Massive integrated investment there, too, under programs like PM Gati Shakti.
Gati Shakti. What's the idea behind that?
It's about breaking down silos between government departments, planning roads, railways, ports, industrial zones together in an integrated multimodal way.
So things actually connect properly.
That's the goal. Eliminate bottlenecks, cut logistics costs, reduce transit times, make India physically a more efficient place to make and ship goods. Development of dedicated freight corridors, logistics parks. It's all part of that push.
Okay. And beyond the physical infrastructure.
The digital India and startup ecosystem is also crucial. They've created this strong tech foundation that really complements manufacturing.
How so?
India's pushed a strong tech ecosystem, built world-class digital public infrastructure, think UPI for payments, Aadhaar for identity.
Things we use every day now.
Right. Plus e-governance initiatives. This has fueled a booming base of tech startups and software talent.
Which helps manufacturing how?
Provide support in areas like supply chain tech, data analytics, automation, factory management software. It's a key enabler for modern manufacturing.
Interestingly, what about internationally? Trade deals?
Also a focus. Strengthening ties through strategic trade agreements and partnerships.
Which countries?
They've sealed FTAs with the UAE and Australia recently. Talks are ongoing with the EU, UK, Canada, aiming to cut tariffs, open up export markets.
And aligning with other countries on supply chains.
Yes, actively promoting trusted supply chains with partners like the US, Japan, Australia. Fits that broader global goal of diversification and resilience.
Okay. And one last big push area. Semiconductors.
Absolutely. A very targeted, ambitious push in the critical semiconductor and electronics sector.
Why so much focus there?
Huge strategic importance, right? So India launched a massive $10 billion semiconductor mission, aiming to develop chip fabrication plants, fabs, and display units domestically.
Are companies biting?
Yes, it's attracting major players. Micron, the U.S. chip giant, is building an assembly test plant in Gujarat. Vedanta Foxconn had plans. Tata is getting into the space.
So moving up the value chain, not just assembly.
That's the ambition. Building foundational capabilities in a sector vital for future tech. Signals India's long-term goal to be a high-tech manufacturing hub.
Wow. Okay, so taken together, PLI, Make in India, reforms, FDI, infrastructure, digital, trade, semiconductors. It's a really comprehensive effort.
It really is. A concerted push on multiple fronts to make India a genuinely attractive, competitive place for global manufacturing.
And is it working? What's the real impact on the ground so far?
Well, the impact is definitely becoming visible. We're seeing policy translate into actual investment.
Like with the big tech companies.
Exactly. Apple is a prime example.
Oh.
Along with its main partners, Foxconn, Pegatron, Wistron, they are seriously expanding iPhone assembly in India.
How much expansion are we talking?
Some sources suggest Apple might shift as much as 25% of its iPhone production to India by 2025.
25%. 1 in 4 iPhones made in India.
Potentially, yeah. Think about that. A company like Apple, famous for its super tight supply chain control and premium products, moving a significant chunk of production. That's a massive vote of confidence in India's growing capabilities.
Huge endorsement. Anyone else?
Samsung set up the world's largest mobile phone factory in Noida, near Delhi. another huge signal.
And in semiconductors, you mentioned Micron.
Yes. Micron building that assembly and test plant in Gujarat. That's a direct result of India's semiconductor mission and the PLI scheme for that sector.
What about electric vehicles? EVs?
Players there, including big names like Tesla, are actively exploring local production and setting up supply chains in India. They see the huge domestic market potential and the government's green energy push.
So tangible signs across different sectors. It's not just talk.
No, these are real investments happening.
Eh.
India's policies and incentives are clearly starting to move the needle, attracting significant industrial capacity.
Okay. This inevitably brings up the comparison with China, doesn't it? How did China achieve its success? And how does India's approach, maybe even its internal societal structure, differ?
That's a really interesting angle some of our sources explore, looking beyond just policy to foundational differences.
What kind of differences?
Let's start with language policy. One perspective we saw suggests China made a very conscious choice back in the 70s under Mao.
To focus on Mandarin.
Primarily, yes, for education, for business. They minimized the focus on English in schools, essentially saying, we'll learn in Mandarin.
How did that help?
The argument is it allowed their workforce, their brain power, to focus squarely on core work, on technical skills, without the added burden of mastering a foreign language simultaneously.
And dealing with the outside world.
Technology helped bridge the gap. Real-time translation tools for trade and business communication.
Okay. How does that contrast with India, according to this view?
India places a strong emphasis on English, especially in higher education and business. But for students from some regions, the source mentions UP, Bihar, Jharkhand, major sources of labor.
Yes.
Access to good English medium schooling can be a challenge due to financial issues. Despite being very hardworking, they might struggle to fully grasp complex technical subjects taught only in English.
So the language itself becomes a hurdle.
This perspective suggests it can. They may be consuming, say, 70% of their learning time or mental energy just overcoming the language barrier, diverting focus from the core technical skills needed in manufacturing. Affects confidence, too.
Wow, that's a really different take on human capital development.
It is a fundamental difference in approach highlighted by this source.
Okay, language policy is one. What else?
Gender roles in the workforce, another critical difference noted.
How so?
China's rise effectively utilized both male and female workers, often in complementary roles. Think women in indoor factory assembly, men in outdoor marketing, sales, exports.
A kind of division of labor.
Yeah, culturally reinforced. It maximized the available labor pool, ensuring both genders contributed significantly to the economy.
And in India.
While things are definitely changing, and women excel in many sectors, traditional expectations in some parts of the country have historically led to lower overall female labor force participation, particularly in formal manufacturing roles.
So a potentially smaller available workforce.
This view argues yes. It means a significant segment of potential talent is underutilized in those specific areas, placing a heavier earning burden on men.
And the source links this to
Men sometimes working in unsafe conditions far from home. Families may be unaware of the struggles. The economic point is that lower female participation can limit the total skilled labor pool available, impacting competitiveness.
another really interesting societal factor. What was the third difference mentioned?
A perceived difference in mindset, realistic versus ideological thinking.
Okay, explain that one.
The source characterizes China's approach as often highly realistic, pragmatic, execution-focused. The road will be built, the work gets done. Prioritizing swift implementation, tangible results, even if it requires top-down decisions.
Get it done, basically.
Right. India, in contrast, is described as sometimes having a more ideological approach,
I mean,
perhaps more focused on what should be, navigating diverse opinions, democratic processes, which is vital, of course.
but maybe slower sometimes.
That's the implication. More deliberation, consensus building, which might impact the sheer speed and scale of development compared to a more centralized, pragmatic model.
So language, gender roles, fundamental mindset. These internal factors, according to these sources, also play a distinct role in how each country's industrial journey unfolds.
Yeah, shaping their competitiveness in different ways.
Fascinating. But coming back to the +1 race, India's made strides, but it's not alone, is it?
Oh, far from it. What's fascinating here is the intensity of the competition. India's done a lot, but many other Asian countries are actively vying for that same investment.
Who are the main competitors?
You've got established players and rising stars: Thailand, Malaysia, Bangladesh, Cambodia, and especially Vietnam.
Vietnam comes up a lot.
They're not standing still. They're aggressively pursuing similar strategies, reforms, incentives to lure manufacturers.
Tell us more about Vietnam's success story. It seems remarkable.
It really is, offers a strong comparison point. Vietnam's seen incredibly rapid export growth, nearly matching India's total exports back in 2019.
Wow. In specific sectors, too.
Yes, it's even overtaken India in key areas like textiles. The U.S., for instance, now sources more garments from China, Bangladesh, and Vietnam than from India.
How did Vietnam achieve that?
A mix of strong reforms and really strategic infrastructure development. Their 2030 master plan is incredibly ambitious.
What's in it?
Things like 5,000 kilometers of new expressways, developing deep-water ports like Lac Huyen, high-speed rail routes connecting economic hubs.
So focusing on connectivity and logistics.
Exactly. Vietnam's appeal isn't just cost anymore. It's agility, its strategic location, and a government laser-focused on making foreign investment easy through streamlined processes and that aggressive infrastructure build-out.
And it's not just Western companies going there.
No, that's really interesting. Vietnam is also becoming a preferred spot for Chinese companies looking to diversify their operations.
Why would Chinese companies move?
Maybe escaping zero-COVID issues back home, rising domestic costs, or just wanting geographic diversification themselves. Companies like HL Court, bike parts, Shenzhen H&T, intelligent controls, TCL, electronics, they're shifting parts of their operations to Vietnam.
Okay, Vietnam is a major contender. What about Thailand?
Thailand's also making a serious play. They've worked hard on improving the ease of doing business,
Oh.
making permits easier to get for construction, infrastructure, streamlining laws to protect minority shareholders better.
And has that paid off?
It seems so. FDI in Thailand jumped 80% year-on-year in the first quarter of 2021, especially in high-value areas like medical equipment manufacturing, advanced electronics.
So Thailand has its own strengths.
Definitely. An established industrial base in some areas, skilled workers in certain niches, good location in Southeast Asia. It's a strong competitor.
So the message is, India's efforts are significant, but the competition is absolutely fierce.
Fierce. And other nations are equally, maybe even more aggressive, showcasing their own advantages. It's a real race.
How is India actually faring in that race, numerically? Do we have any data on where companies are really moving?
Yeah, some numbers paint a striking picture of the challenge. There was a study by Nomura, the Japanese financial firm.
Okay.
It looked at the period between April 2018 and August 2019, found 56 companies that explicitly relocated production from China.
And where did they go?
Well, only 3 moved to India.
Only 3 out of 56.
Yep, in stark contrast, 26 went to Vietnam,
26.
11 went to Taiwan, and 8 to Thailand.
What? Wow. That really puts it in perspective. So India is getting some benefit, but maybe not the lion's share yet.
Exactly. India has benefited from some trade diversion machinery, toys, furniture. But the volume isn't yet significant compared to what some Southeast Asian markets have captured.
So the policies are there, India's on the map, but converting that into large-scale factory moves, still a work in progress against tough competition.
Precisely. Different nations are succeeding by playing to different strengths. It shows sustained effort is needed for India to capture a bigger piece of the pie.
Okay. This brings us back to China. Despite all this talk of +1, China still holds significant sway, doesn't it? Why don't companies just leave entirely? Why +1 instead of -1?
That's a crucial point. China retains this powerful, almost gravitational pull. It actively repels a complete exodus by leveraging its fundamental, enduring advantages.
Makes it hard to leave completely.
Very hard, and often commercially nonsensical for many global players.
What's the first big reason?
Remember the dependency on crucial parts.
Right. Even if assembly moves, the key components often still come from China.
Exactly. Specialized chips, specific raw materials, complex sub-assemblies. China's mastery in producing these at scale and cost is unparalleled. Companies just don't have easy alternatives that match that efficiency or capacity or sheer variety.
Can't just flip a switch and source everything elsewhere.
No way. Decades of integration are hard to untangle quickly. That embeddedness keeps companies linked to China, even if they diversify assembly.
Okay, dependency on parts. What's the other major factor keeping companies partially invested in China?
It comes down to efficiency and market size. 2 huge linked advantages.
The supply chain efficiencies we talked about earlier.
Yes, the unparalleled ecosystem built over years. Thousands of specialized suppliers, skilled engineers, workers, sophisticated logistics, all seamlessly integrated.
Abandoning that would mean losing a massive competitive edge.
An edge many companies can't afford to lose, especially when you add the second part, the sheer immense size of the Chinese domestic market itself.
Can't ignore those consumers.
Absolutely not. It's a colossal market. Walking away means sacrificing access to potentially billions in revenue.
So the plus one strategy is really an acknowledgement of these strengths.
Exactly. It acknowledges China's enduring importance. It's about diversifying risk, building resilience, adding flexibility.
Not about wholesale abandonment.
Right. Global value chains are constantly adapting, restructuring. But that restructuring currently looks more like diversification than a complete severing of ties with China for most major companies.
Okay, so let's bring it back to India's path forward. We've seen the efforts, the competition, China's resilience. What does this mean for India's long-term prospects? What hurdles remain?
Right. While India's made huge strides and seen real impact, there are still bottlenecks, challenges that need addressing to really maximize this China plus one opportunity and sustain the momentum.
One of the main ones our sources point to.
Still some persistent bureaucratic hurdles, especially at state and local levels. Navigating permits, different interpretations of rules across states, it can still complicate things.
Consistency is key.
Absolutely. Then there's a skill mismatch in advanced manufacturing. India has a huge workforce, but maybe not always enough people with the specific high-tech skills needed for the sophisticated factories it wants to attract.
A training and education challenge.
Yes, and despite big investments, infrastructure bottlenecks still exist in some regions, hitting logistics efficiency, moving goods smoothly.
So more work needed there. What about the legal and policy side?
A continuing need for faster dispute resolution. The IBC helps, but speed matters. And policy consistency is crucial for investor confidence. Shifting regulations can scare investment away quickly.
Predictability is vital.
Hugely. Plus, ongoing reforms are needed in areas like labor law flexibility, stronger contract enforcement, and further reduction of bureaucratic delays, all vital to compete globally.
And trade policy.
Some sources note India's historically somewhat protectionist trade policies haven't helped it integrate into global value chains as fully as competitors like Vietnam, which were more aggressive on trade liberalization.
So maybe more openness needed there?
Potentially. And finally, just the ability to react quickly, to adapt policies fast to the changing global scene like Vietnam has shown it can, to grab opportunities as they arise.
Agility.
Exactly. Sustained effort and agile policymaking in all these areas are critical for India to really become a dominant plus one.
Okay, those are the challenges. But what about the specific opportunities? Are there sectors where India is particularly well placed?
Yes, absolutely. And these aren't just general opportunities. There's specific areas where India seems almost tailor-made to fill gaps potentially being left by China.
Like what? Give us an example.
Okay, take the textile and apparel sector. China's been the world leader, right?
For sure.
But now it's facing significant cotton yarn shortages, partly geopolitics, partly policy, and seems less keen on investing more in basic textiles.
Creating an opening.
A massive opening. And India, it has its own strong textile history, a good cotton base. This could lead to huge investment, maybe Rs 20 crore in capex over 10 years, just meeting rising global demand shifting away from China.
So a structural shift India can exploit.
Perfectly positioned to fill that vacuum.
Interesting. Any other sectors like that?
The specialty chemicals industry is another prime example.
Chemicals.
Yeah. China was the world's biggest maker.
Hmm.
But a few years back, they consciously decided to exit or cut back significantly in many areas.
Why?
Mainly due to severe ecological damage and a strategic move towards higher value stuff. Sustainability concerns.
And India's response.
According to one source, India has grabbed the opportunity with both hands.
Stepping into the gap.
Exactly. Filling that supply chain void. Indian chemical companies are continuously expanding capacity, aiming to meet global demand for these vital chemicals.
So becoming a reliable global supplier in a space China is partially vacating.
Precisely. It's a major shift in a critical industry.
Hmm.
India isn't just replacing capacity, it's potentially becoming a more sustainable, reliable source for the long term.
Okay, so beyond specific sectors, what's the overall approach India needs?
Relentless focus on the fundamentals that attract manufacturers. Reliability, low cost, good quality, and on-time delivery. Those are the table stakes.
Get the basics right consistently.
Absolutely. And give equal importance to export and domestic trade. Serve both markets. Plus, continuous capacity expansion across key sectors.
Keep building.
Keep building. Look, India is genuinely in a sweet spot right now. Demographic dividend, huge domestic market, favorable geopolitical
The
winds,
potential is definitely there.
huge potential. But to fully capitalize on this unique China plus one situation, it needs to keep reorienting policies,
Hmm.
make them agile, consistent, truly conducive to attracting and keeping that global manufacturing investment for the long haul.
Okay, so let's try and wrap this up. To summarize our deep dive today, this China plus one strategy, it's really complex, isn't it? A big global shift.
Definitely multifaceted, driven by so many things. Cost, yes, but also risk. Geopolitics, the pandemic, China's own evolution.
Right. And India has clearly made impressive, comprehensive efforts to position itself as a real alternative. The reforms, the incentives, they are having a tangible impact.
They're showing results, yes, but
But it faces fierce competition, especially from agile players like Vietnam and Thailand. And there are still internal hurdles, bureaucracy, infrastructure gaps that India needs to keep working on.
exactly. To truly maximize its potential and grab a larger slice of this global manufacturing shift.
So it's not a done deal, but the direction seems set.
The landscape is definitely changing.
Which leads to a final thought, maybe a question for you, the listener, to mull over.
Yeah, this raises an important question. Given China's enduring strength, that efficiency, that market size, and how dynamic global supply chains are, what does a truly balanced, resilient global manufacturing future actually look like?
Is it a complete shift away from China?
Or is it more like an intelligent rewiring?
Yeah.
A more diversified network where multiple plus ones thrive alongside China, each specializing, creating a more distributed, robust system.
And thinking about India specifically.
What role do you think things like policy consistency, developing adaptable workforce skills, and pushing through those infrastructure projects will play in shaping India's destiny in this new manufacturing world? Where does India ultimately fit in that rewired future?
Lots to think about there. It's a fascinating story, and it's definitely still unfolding. Thank you for joining us on this deep dive into the evolving world of global manufacturing.